If you're looking to venture into the world of commercial real estate investing, one question looms large. What type of commercial real estate holds the greatest potential for profit? While the answer may vary depending on factors such as location, market conditions, and your individual investment goals, I'm going to provide you with an overview of some of the most lucrative commercial real estate sectors. By understanding the characteristics and opportunities associated with each property type, you'll be able to make informed decisions and set yourself up for success. Multifamily properties. Multifamily properties such as apartment buildings or complexes have consistently demonstrated strong income potential. The demand for rental housing remains high in many markets, and steady cash flow can be achieved through monthly rental payments. Moreover, favorable financing options and the ability to scale investments make multifamily properties an attractive choice for beginners. Let's go over the pros of investing in multifamily properties. One of the primary advantages of investing in multifamily real estate is the potential for steady cash flow. With multiple units generating rental income, investors can benefit from a consistent stream of monthly payments. This income stability can provide a reliable source of cash flow for you to cover any expenses and generate profits. Multifamily properties can offer economies of scale that are a huge benefit to you as an investor. Managing a single property with multiple units is far more efficient compared to handling multiple single-family properties. Consolidated management, maintenance, and operational costs can lead to increased stability and a streamlined investment portfolio. Multifamily properties attract a wide range of tenants, from young professionals to families and retirees. This diversity helps minimize the risk of vacancy and allows for a broader market reach. By catering to different demographics, investors can reduce the impact of potential tenant turnover and maintain a more consistent occupancy rate. Now for the cons of investing in multifamily. Compared to single-family properties, multifamily assets often require a larger upfront investment and likely require you to syndicate the property. Acquiring and financing a multifamily property can be far more complex, involving higher down payments, stricter lending criteria, and potential commercial loans. As a result, the initial capital requirement for entry into the multifamily market can be a barrier for some investors. Managing a multifamily property entails greater responsibilities and involvement compared to single-family homes. Dealing with multiple tenants, coordinating repairs and maintenance, and addressing various issues can be time-consuming and demanding. Investors must be prepared to handle tenant relations, lease agreements, and property management tasks efficiently. The success of a multifamily investment is closely tied to market conditions and factors that influence rental demand. Economic downturns, shifts in demographics, and local market fluctuations can impact your rental rates, occupancy levels, and property values. You need to conduct thorough market analysis and due diligence on these assets to mitigate these risks and ensure the long-term viability of their investment. Retail centers. Investing in retail centers such as shopping malls or strip centers offers the opportunity to tap into triple net lease benefits, where the tenant pays their pro rata share of the common area maintenance, property taxes, and building insurance. Well-located retail properties with a mix of established anchor tenants and complementary smaller businesses can generate steady rental income for you. However, it is crucial to assess the evolving retail landscape and consider factors like e-commerce competition and consumer trends when evaluating the profitability of retail investments. Now for the pros of investing in retail centers. Retail centers have the potential to generate significant returns on investment, particularly in prime locations with high foot traffic. Successful retail centers can attract well-established retail brands and experience steady tenant demand, leading to increased rental income and potential for capital appreciation. Compared to other commercial property types such as office or multifamily properties, retail centers often benefit from longer lease terms and stable tenant occupancy. Many retail leases are structured as long-term leases, which provides investors with more predictable income streams and reduces your turnover risk. Retail centers offer the opportunity to create a synergistic tenant mix where complementary businesses can attract a broader customer base. By curating a mix of tenants that cater to different needs and preferences, retail centers can enhance customer experience and create a destination that drives higher foot traffic and sales. Now for the cons of investing in retail centers. Retail is a dynamic and competitive sector that can be influenced by changes in consumer behavior, economic conditions, and online retail trends. Market volatility and shifts in consumer preferences can impact tenant success and overall performance of your retail center. So you must stay attuned to market trends and be prepared to adapt to changing dynamics. Retail centers can experience higher tenant turnover compared to other commercial property types. Businesses may face challenges, such as changing market conditions, increased competition, or financial difficulties, just like you as an investor, leading to potential vacancies. You must carefully manage tenant relationships, conduct thorough tenant screenings, and have strategies in place to minimize vacancy risks. Retail centers often require ongoing maintenance, repairs, and periodic renovations to attract and retain tenants. The costs associated with maintaining the property, managing common areas, and updating facilities can be substantial. You will need to budget for these expenses and ensure that the property remains visually appealing and well maintained to attract quality tenants and customers. Industrial properties, including warehouses, distribution centers, and manufacturing facilities, have gained popularity over the last economic cycle due to the growth of e-commerce and the need for efficient logistics infrastructure. With the rise of online shopping, demand for storage and distribution spaces closer to consumers has surged, making industrial real estate a potentially lucrative sector for investors. Now for the pros of investing in industrial properties. Industrial tenants benefit from a consistent and growing demand driven by various sectors, including manufacturing, logistics, warehousing, and e-commerce. The rise of online retail has increased the need for distribution centers and fulfillment facilities, creating a strong and stable demand for industrial properties while inventory hasn't been able to catch up. Industrial tenants often sign long-term leases, which provides you a stable cash flow and reduced turnover risks. Many industrial leases have built-in rent escalations and extended renewal options, offering an even higher level of predictability in rental income. Plus, it can often be difficult for industrial tenants to relocate their businesses due to the higher costs of moving. Compared to other commercial property types, industrial properties typically require less day-to-day management. Tenants in industrial properties often handle their own operations and maintenance, resulting in fewer landlord responsibilities and lower management costs for property owners. And on to the cons of investing in industrial properties. Industrial properties may have a narrower pool of potential tenants compared to other commercial property types. The specific requirements and infrastructure needed by industrial tenants can limit the pool of prospective occupants, potentially leading to longer periods of vacancy if there is a lack of demand in a particular location. Investing in industrial properties requires you to have a certain level of specialized knowledge and understanding of the sector, including familiarity with zoning regulations, environmental considerations, and logistical requirements. You may need to engage with industry experts and professionals to ensure proper due diligence and successful property management. Industrial properties often require significant upfront capital investments due to their specialized infrastructure and operational requirements. Upgrading or retrofitting industrial properties to meet specific tenant needs can be costly, and ongoing maintenance and repair costs can also be substantial. You should carefully assess the financial implications and potential risks associated with these capital-intensive investments. Now, I will say at the end of the day, any type of commercial real estate can be incredibly profitable for you depending on your knowledge, your strategy, and how you plan to structure these deals. Learn more about structuring commercial real estate investments here.